Morning, everyone. So by way of introduction, I've been at Credit Suisse for a couple of decades, and I focus primarily on equity capital markets, sometimes the public markets, but also the private markets. So rather than go through lots of slides, perhaps to follow on some of the discussion points that were just raised. Firstly, this concept of Europe being a smaller, less liquid market than the US, and whether that has an impact on valuation. I think our view is, yes, in some respects, Europe is a smaller market, but recent experience suggests that the valuation outcomes you can get in Europe are no different, frankly, from the US, largely because most of the investors you're targeting in the public market are the same. Having said that, in an environment, and I don't know if you can see the slide, but in an environment where obviously this year it's been really tough if you're just buying the market to make money. You know, you try and predict what happens when candidate Trump becomes President Trump. Consensus view market down at least high single digits. Yesterday, green tape everywhere, albeit after a very presidential speech before the US and Europe opened, which obviously helped the futures. But an environment where it's actually been a disaster unless you're a stock picker to make money. Now, if you look at the returns this year in Europe, if you're long basic resources stocks, you've made out like a bandit. If you're long telcos, you've done really badly. So it's an environment where you need to be thoughtful in how you commit capital. It's also, though, an environment where, just as you can go to the public market, you can also consider the private market. And one of the drivers of that decision is whether the public market is risk on or not. You know, there's been a lot of talk about the IPO market in Europe recently being really challenged. The reality is, returns year to date are actually up 9%. So if you'd bought all of the European IPOs that have come out year to date, you'd be up 9%, and that's in dollars. Whereas if you're long the Euro stocks, you're down 6%. So investors actually are making money in IPOs. The problem is that the absolute level of activity has been quite muted. And again, coming on to this point and reiterating this point around relative liquidity, and Carsten was talking about the US versus Europe, but do you know, does anyone in this room know that for the last 2 years, IPO issuance in Europe has been substantially greater than in the US, right? Year to date, over $30 billion. In the US, just over 20. And last year, you know, similarly, massive outperformance. So this idea that you have to go to the US for liquidity, or there's greater liquidity, you know, I think you need to temper that in the back of your mind. And then also the point about returns. You know, why do investors buy IPOs? They buy IPOs for outperformance. So the IPO market, when it's open, tends to be when people have risk appetite. When it closes or becomes less certain, then there can be other opportunities to finance outside the public market, or companies can decide not to float. And when we look at the opportunity in Europe, just to come back to some of the other points made earlier, there is massive scarcity value in Europe. There is hardly any way to play internet in Europe. And if you actually look at the growth outlooks for Europe and think about what's just happened, you know, yesterday, at the end of the day, the whole setup of public markets' view on the outlook for equities has changed, right? The concept of inflationary pressures in the US, but also in Europe. The implication for that, if you're along a bond portfolio versus equities, how do you want to be positioned for the next 5, 10 years? Do you really want to have a massive underweight on equities? And then on the relative argument case, yes, there's better GDP growth in the States, but European GDP is actually pretty good right now. You know, 1.5, 1.6 next year. And the P differential, on average, in Europe is about a 20% discount. You know, the S&P trades at a 20% premium, plus or minus, to the Euro stocks. So against that backdrop, when people are thinking about growth opportunities, and when they're thinking about where do they commit capital to, our issue, frankly, on the banking side, because in addition to the exchanges, obviously you work with advisors, and Credit Suisse has a big technology platform, and a good internet presence, and it's a global presence. But our focus is all about how do we find the clients, the issuers, to bring to the market. Now, some of you are still too small, but many of you are not. And I think the opportunity over time, particularly as the European market continues to develop further, is huge. It really is huge. The returns are more modest, and that's partly because in the US you can float less, and people tend to just do a small primary deal, and they let it trade up 50%, and everyone's happy. In Europe, you tend to have minimum free float requirements, and there is more focus on liquidity, so it's easier to do a $200, $300, $400 million free float deal than a $50 or $100 million deal. And that means the size of the companies coming to market tends to be bigger, because 25% equaling 400 means the market cap is 1.6 billion, whereas in the US you could have a €1 billion or $1 billion market cap company and just raise 50 or 100 and do a smaller free float. So it's easier to accept the dilutive pain of seeing that 10% of primary trade up 50%. You're still a shareholder of the balance, you can live with that. But if you've got a company worth 1.6 billion, you float 400 and it trades up 50%, I don't think you should be feeling good about your advisors. So there's that complication as well. But I think my main point is there's huge scarcity value in Europe. People want to buy the exposure, and there just isn't enough of it. On the point about just how bad it's been, in recent years, 14 and 15, with the likes of Zalando, Zoopla, Just Eat, and a whole host of others, you've had companies that have generated fantastic returns for investors, and they've generated huge demand, both locally in their local market of listing, pan-European as well, and global money coming out of the States. There's plenty of interest in Europe. The problem, frankly, is with you guys, and it's getting you to come to the market. And maybe on that point, why on earth would you want to go to public? Why would you want to go public? You have to put yourself out there. There's more disclosure requirement. You have to have a set of financials that's robust. You'll need appropriate independent boards. You have to think about how are analysts going to react to what you say every time you publish numbers. You have to spend a lot of time away from your business, just running the optics and the IR. That's a clear negative. And one of the reasons why, in a world where rates have been very low for a long time, there's been a huge amount of capital chasing smart investment ideas. If you're trying to buy secular growth opportunities, what do you want to do? Buy utilities? Buy banks in the new heavily sort of regulated high RWA world? Or do you buy growth? Do you buy the future? You buy tech? You buy internet? It's not very complicated, and it's pretty obvious that most portfolio managers want a significant portion of their portfolio to have exposure to that growth. However, in an environment where rates are low, where the IPO market's been a bit choppy, where the US market isn't that strong and hasn't been that strong in terms of the IPO market, if Fidelity and BlackRock and Wellington will write you a check for $200 just to own your equity privately, you hit the bid, right? And look at the trend, 14, 15, 16, the number of these unicorns, the size of these companies. We think you should all think about that. And by the way, there is plenty of capital in Europe. I've got a team running 3 private placements right now, 2 of which are in the tech space, and 1 of which is targeting $300 million and likely to close in weeks. So there is capital looking at European-based internet and high-tech opportunities. There are lots of benefits of private capital. At the same time, Carsten had a good point. As a source of diversifying your sources of capital over time, a public listing can give you more optionality. It can give you a broader pool and depth of capital. It can give you a currency to buy. It can give you, potentially, if the market is risk-on, a higher valuation, because a rational institution will always want a higher return for an illiquid private holding versus a liquid holding they can trade in and out of. Not particularly complicated, it's just obvious. But where there's scarcity value, and where there's this big for diversification and exposure to tech, for many of you, it will actually be a much better solution initially, after the initial VC rounds, to think about a private round before you IPO. Having said all of that, if the IPO market is totally on fire, you'd be illogical not to hit the bid and not to take advantage of public capital. And when it works, it can work extraordinarily well. You have much more competition for the equity. You can get a better value, potentially, by giving more public disclosure. And if you can provide sufficient liquidity, you are de facto broadening the pool of capital you go to. My one vision is that the European tech listed universe in 10 years' time is in a different zip code. It's underrepresented. You're underrepresented, and we need to fix that. You shouldn't all go to the public market. It's certainly not right for all. But for many companies, it's an amazing way to crystallize value, and it's an amazing way also to broaden your strategic optionality around the future growth of your businesses. Last point, Credit Suisse is one advisor. You need to pick the right advisor. We'll be the right for some. We'll be the wrong advisor for others. But we've got a great team. It's a global team. It's got huge continuity in terms of its understanding of the sector. We've raised $55 billion in internet equity in the last recent years, and we know how to give the right advice. We know to tell you when not to float, and when to tap the private market, and when not to. And the only other thing I'd say is this point around relative liquidity in US versus Europe. It's a myth. A decade ago, fair enough, maybe there was a valuation disconnect. There isn't today. It's all about building the scale and the profile of Europe. We're not there yet, but we'll get there, and we need all your help to do that. Thank you very much.